Now, there's a huge group of people and stock market investors that think that there is going to be a massive correction, a massive stock market crash within the next year or so. And although for me personally speaking, I'm sort of in the camp that I just want to keep buying stocks and ETFs over the long term and buy some assets for cheaper, more expensive, and overall have it just average out to a decent amount during retirements. But the good news for those investors that do think that there is going to be a potential massive correction or stock market crash within the next year or so. As of right now, because the Fed funds rates are still so high, there is a massive amount of yield to be offered in things like bonds or CDs, which you can basically park your money as of right now risk-free more or less and earn around 5 to 6% per year in interest. And the cool thing about this is that you have your money basically stored away in a safe spot, earning a decent amount of money on it. And then if there is a potential crash in the future, you could of course use that money later on and buy assets for much cheaper potentially. But in this video specifically, we're going to be talking about what a certificate of deposit is, or a CD, and how you personally can buy CDs, brokered CDs, on two different platforms. The platforms being the Fidelity platform as well as the Schwab platform. So if you're an investor thinking that there could be a crash ahead, or if you just want to earn a nice juicy yield because of the higher than normal interest rates, and you want to learn how to buy brokered CDs on either one of these platforms, make sure to stick around, drop a like down below, and let's get right into this one. So before I go through and show you exactly how to purchase a brokered CD on the Charles Schwab platform, let's first go over exactly what a CD even is, what a certificate deposit is, for those that might not be aware. So this right here says a certificate of deposit, or CD, which is most of the time what you hear them as, is a type of savings account offered by banks or credit unions. You generally agree to keep your money locked in with the CD without taking a withdrawal for a specified length of time. And sometimes withdrawing the money early can mean paying a penalty, or maybe you lose some of the interest, etc., etc. Now, there's of course many different ways to buy CDs. You can go directly to a bank, you can go directly to a credit union, you can buy CDs multiple different ways across the internet even. But one of my favorite ways on buying CDs, at least over the last year or so, I've been doing a ton of this on my own time, is buying brokered CDs, which is basically buying CDs right through the brokerages that you already trade stocks on. Now, in the past, I purchased CDs on TD Ameritrade, which is now Charles Schwab, of course. I've also purchased brokered CDs on Fidelity, and overall, whatever broker you're really using, it's pretty much more or less the same. But at least on the Charles Schwab platform, if you go up here to trade, you would then see all these different options, which of course, we're going to be clicking on CDs for this video. Then after you click on CDs, this is exactly what you're going to see. And side note, there are multiple different ways to do this even on this platform, but this is the way that I do it. So right here, you're going to see, visit Find CDs for a detailed CD search experience, and also Schwab's highest yielding CDs by maturity. Now, when it comes to buying CDs, they're going to offer different maturities, which is basically how long you agree to have your money locked into this asset. Now, for example, the maturities go from anything from 1 month, 3 months, 6 months, 9 months. Then we have the most popular one, at least as far as my experience goes, is 1 year. Then we have 18 months, 2 years, 3 years, 4 years, 5 years. And sometimes even in the past, I've seen upwards of 10, 20 years to have your money locked into a CD, which honestly, I don't know why anyone would want to lock their money into a CD for 10, 20 years, unless we saw some sort of black swan event where CDs were paying like upwards of 7, 8, 9, 10%. But regardless, that's not really my problem. Now, below that, you're going to see APY. This is basically more or less how much interest or how much yield you're going to earn by buying to the CD. Another important thing to note is when you are purchasing CDs on brokerages or brokered CDs, at least from what I've seen, every single time you purchase one CD, it's going to be $1,000. 2 CDs means $2,000. So basically whatever the quantity is, it's going to be times that by 1,000. Now there might be different ways to do this to not have to buy 1,000 or maybe more at a time, but that's just in my experience. So keep in mind, one CD normally means 1,000. Now, as far as the different maturities and of course the different APYs, you're probably asking, or maybe you're curious, why are there different yields? Why are there different amounts that I'm going to get paid depending on how long I lock in the CD? Now, the simple answer to this is that CDs are basically, for the most part, based off of the Fed funds rates. And in the future, if rates are going to be going lower, well, the longer you're locking your money, the providers of the CD or the issuers are not going to want to pay you as much money, most likely, if, of course, the Fed fund rate goes down in the future. Like for a real life example, at 1 month, 3 month, 6 month, and 9 months, those are all much higher APYs as of right now versus 1 year. So this is indicating that at least it's being priced in that rates might be lower within the next year, but at least for the next several months, rates are probably going to remain pretty high, or at least around these levels, which is why you're going to earn quite a bit more if you lock in a short-term CD versus a 1 year, 18 months, or even 5 year. If you look at the delta here, a 1 month maturity CD is offering around 5.48% versus a 5 year CD, which is offering 4.7%. So basically, when it comes to you and your strategy, you're going to have to ask yourself, how long do I really want to have my money locked into the CD? And depending on how long you're willing to do that, you're going to get paid a certain amount. So now that we understand maturity, APY, this is the fun part. You go through here and it's basically sorted through the highest coupon or the highest APYs to the lowest APYs. And of course, there's going to be different coupon frequencies like at maturity or even semi-annually, which just basically just means how often you're going to get paid the interest from the CD. So keep in mind, a lot of these broker CDs, they don't pay you out every single month, at least not the ones that are offering the highest APY. It's all kind of priced in. If you want to lock in a high APY, you're probably not going to get paid until the maturity date, which honestly hasn't really bothered me at all. That's what I do normally. So this right here is a Wells Fargo CD that's a new issue that's offering a 5.4% coupon or a 5.4% APY. There's plenty of these available right now to buy. The maturity date as of right now is 1 year out, so around June of 2025. So if you were interested in this one, you want to lock in a 5.4%, and keep in mind these are going to change ongoingly depending on what happens with rates and the market, etc. So if you're in the market to buy some CDs, take a look at these pretty often. So we clicked buy on this one and it's going to bring you to this page. Again, this is on the Charles Schwab platform, but once again, every brokerage is pretty similar to this from what I've seen. It shows right here the Wells Fargo Bank's brokered CD at 5.4%, the expiration date or the maturity date, I guess we can call it 6/11/2025, which is more or less a year from now, or 1 year and 10 days to be exact. Now, another interesting aspect of this CD specifically is it's not callable. You're definitely going to see callable CDs across these brokered CDs quite often, which basically means that if the issuer wants to call it early, they can basically give you your money back plus the interest that you incurred during that time frame, and then you go along your way. But for this one, it's not callable, so that means that you are locked in until about a year from now. So if you wanted to purchase, let's say one of these, you would type in $1,000 because as it says right here, the minimum is 1,000, the maximum is 216 million it shows. You would then go through and say if you want to auto rollover, I don't normally do that. You can leave the limit price at the 100 mark. And then of course you click on review order and there you go, you purchased your first CD in the Charles Schwab brokerage. So that for the most part is all there really is to it. Of course you can go into more detail, but it's really not all that complicated. The first time I personally purchased a brokered CD, it was kind of confusing because previous to doing so, I've only went to banks or online bank websites and purchased CDs through them, which it's kind of more user friendly. This interface can be a little bit intimidating at first. But either way, with the way that rates are at right now and the amount of money that you can earn currently in bonds and CDs, I think it's a great opportunity to lock in some money for a short time frame or maybe even for a longer time frame, get paid a nice, stable, guaranteed yield, because of course also, for the most part, at least what I've seen, these are all FDIC insured also. So what a better way to lock in some side cash or lock up some idle cash you're not necessarily going to spend today or tomorrow and earn a nice solid yield for doing so. But without wasting any more time, how to buy a CD in the Fidelity brokerage. So first of all, you're going to want to log into Fidelity like any other time. Then you're going to want to hover over news and research. Now in here you see news, wealth management insights, watch list, etc., etc. You're going to want to go all the way down to fixed income, bonds, and CDs. Now once you click on that, it's going to bring you to this page right here. Now just a side note, there's going to be many different ways to navigate to the same place, like pretty much any other website these days, but in this video specifically, I'm going to show you exactly how I do it. So then you're going to see all this right here. You're going to see and understand the table. You're going to see CDs, new issues, which are going to be newly issued CDs, which is what I always use. And then underneath that, you're going to see bonds, things like US Treasuries, US Treasury zeros, agencies. You're seeing corporate, AAA, corporate AA, corporate A. You even see corporate B, taxable, municipal, and municipal bonds, etc., etc. Now, even though there's so much to go over, in today's video, we're just going to be talking about CDs, which is what I personally have a substantial amount of money invested into as of right now, just because rates are so high and I don't need some of this cash today or tomorrow. Now, right here on CDs, you could of course click them right here, or you could look up here where it shows different time frames. Now, the time frames that are offered as of right here show 3 months, 6 months, 9 months, 1 year, 2 year, 3 year, 5 year, and then if there are any, 10 year, 20 year, and 30 year. Now, this is basically the duration of the CD. So if you have some cash on the sidelines that you want, not maybe today or tomorrow, but maybe in a few months, then maybe a 3-month duration CD could be a good option for you. If you want a little bit longer of a time frame, a 6-month, a 9-month, a 1 year, etc., etc. Now, the first thing that you might see is that there's different percentages, there's different interest rates that are offered depending on the time frame. And this is largely going to have to do with things like what the market is predicting that interest rates are going to look like long term. So as you can see, just generally speaking right here, the market is saying that they're willing to pay a little bit more right now because interest rates are going to be higher, at least for now. But in the future, you can see 1 year, 2 year, 3 year, and 5 year, you're only going to get a 5.1% more or less, because again, the market is pricing in that at some point in the next year or two, interest rates should be much lower. So why would they pay more long term? Now, of course, from here, you could click into any one of these, but for me specifically, this is what I normally do. I normally go on a 1-year time frame because if I personally have any money on the sidelines that I'm not really going to stay tomorrow, I feel like I can kind of hold out a year or so until I need that money. And the 1-year duration is also offering the highest interest rate at 5.35%. So let's click into this and see what we get. So we clicked on the 1 year and now it brought us into this page. This is the CD new issue offerings. So this right here is showing us a total of 12 different CDs as of right now that are offering anywhere from 4.9 to 5.35%, but are also offering different metrics in between that. Now, first things first, why are these different CDs offering different coupon rates or interest rates, let's say? Now, this is because some of them are offering different things that others aren't. For example, right here, you can see that there's call protection. Now, call protection is basically just if or if not the CD provider is able to call away the CD early. And honestly, for me personally, at least, if I have money on the sidelines that I'm not necessarily needing today or tomorrow, but also wouldn't mind getting back at any time in the future, call protection is not necessarily all that big of a deal to me. But if you are very dead set on wanting to earn your coupon rate and you want there to be call protection, which means that the CD cannot be called away, well then look for a CD, of course, that does offer call protection. But for me personally, I always look for a good bank or a good provider. And what I mean by that is sort of a big, well-known bank. I personally find it a little bit more risky. Although for the most part, as you can see right here in attributes, they all pretty much offer some sort of protection. These days, it's very common. Now for this example right here, you can see JP Chase, which we all know and love, is offering a 5.35% coupon rate, which is a 5.35% interest rate. The coupon frequency at maturity. So this means that you are not going to get your money or the interest until maturity. So again, if you need access to this money today or tomorrow, this of course would not be a great option for you, most likely. Now it shows right here the maturity date is February 5th of 2025, so more or less a year away. Is this a fractional CD? No, it's not. The yield, like I said, 5.35%. This does not offer call protection. So that means that probably within the next quarter or two, if JP Morgan wanted to, they could close off the CD, pay your money back and any interest, and then basically you go on with your life. And like I said, for me, that's no problem at all. If JP Morgan wants to pay me back early and give me some interest, I'm perfectly fine with that. Now the settlement date is 3/5/2024, so that's basically at what point the CD is going to be basically settled and go into action. The quantity available just shows how many are available, which for the most part, for most of us, we're not really worried about that. I don't think you and I are buying much more than 39,000 of these, which is side note, an important side note, CDs are always, at least on broker CDs, purchased in lots of 1,000. So one CD is $1,000, 2 CDs is $2,000, etc. Next, it shows you the attributes, which is sort of some of these insurance agencies, etc., which right here it says SFP, FDIC, and period 11 months, which is the duration of the CD. So if we wanted this one, we'd go in here and press buy. And then right here brings you to this page. So right here, you would select an account. If you have a Fidelity account, you could of course select whatever Fidelity account you want to buy it through. And then it shows you basically everything here. The price is 100, but like I said, one bond equals 1,000 face value. So if you want to buy one CD, you'd press 1, so 1 CD or $1,000. And I like Fidelity a lot. I like how they make everything very clear and easy. There's no guesswork here. Then just to double check, it shows you the JP Morgan Bank CD at 3.5%, and it shows you the maturity date, etc. 2/5/2025, an 11-month time period, coupon frequencies at maturity, etc., etc. And at this point, you probably already know everything else there is to know about the CD. Hopefully you looked into it on the last page, and if you're comfortable with doing so, you would then go through it and preview order and then purchase it. So now that we went over 2 different ways to buy brokered CDs on either the Fidelity platform and or the Schwab platform, I lastly now want to hear from you guys down below. Are you currently, as of right now, investing any of your cash that sits on the side in CDs like I am personally? Or if not, where do you think the best place is as of right now to invest cash that you're saving on the side for a bigger market correction or crash? Let us know in the comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.